Welcome. My name is Dennise Williams, and I'm here on Financially Focused, really helping you with great expert interviews on how to build your financial table. Now, we want to have four very strong legs on that table, which is your income, your assets, your mindset, and protection. And in that area of protection, we look at insurance and debt management. Now, we love to really drill down into what makes the legs of your financial table so strong. And now we're going to be looking at the asset side. And this is wide and deep and vast and gives us a great opportunity to bring in a lot of different experts. So now the expert we're talking to today is Mrs. Denise Marshall Miller, who has for the last 20 years been building portfolios after portfolios for her clients. And so the asset leg, the long-term savings, the long-term planning leg of the financial table will be on the spotlight in this episode. And in particular, we're looking at mid-career professionals. You've been running around, taking care of your family, going back to school, getting yourself organized, being that great career or entrepreneur person. But do you have a portfolio? Do you have assets working for you? Now, we're in this great space of time in which technology allows us to be anywhere at any time and open accounts. So I'm going to talk about some of the accounts I'm going to look at and we're going to talk about. We're looking really at your crypto, your digital account. Some of us don't believe digital currencies are real, but maybe Mrs. Marshall Miller can change your mind. We're looking at foreign currency accounts. Again, some people don't even believe Forex trading is real, but not only can you trade Forex, you can open accounts with different currencies in it. And there's mutual funds and stocks and even real estate investment trusts. So you can build a portfolio the same time you're busy taking care of your family and building your career or your business. And you can build a portfolio and have a strong leg of assets. So welcome, Denise Marshall Miller.
Thank you, Denise. It's a pleasure to be here.
Yes, two Denises. Yes. So we've been talking about a lot of different assets, paper-based assets that you can establish online. You can put in some of your savings, not all. We're not telling anybody to throw everything in, some, and begin to grow. So let's begin at the beginning. How do you open an account?
Okay, so to open an account, I would say in this day and age, it's pretty simple.
Okay.
You find that the requirements are pretty much the same across most institutions. It's your ID, your proof of address, your tax registration number, and that is
or social security number,
or your social security number, whichever number is based on where you're from. Then you can commence opening that account. So it's typically the same.
Right. So you got to live somewhere. You have to have a number of some form from the government, and you need a photo ID.
Yeah. You
right?
need an ID.
Okay, great. So those three things are pretty simple. Some may ask for source of funds.
Yeah, so source of funds, definitely if you're going to invest. If you go to an investment house, one of the things that they want to establish is what is your source to invest? Is it coming from income? If it's coming from your business? If it's get a sense of what is that cash flow?
Yeah.
Because that also helps that institution to be compliant.
Yes.
As it relates to our AML, FATCA regulations that we need to follow.
So AML FATCA is basically how the government regulates the financial institution.
Correct. So that will give the institution an idea as to what is your cash flow for investments.
Yes.
Yeah. So your source of funds would be, it would be from your 9 to 5. It could be from your business, etc. And you would need to show evidence of this.
Okay, so you know, there's a lot to choose from. There's the stock market, the mutual funds, foreign currency, digital currencies. There's a lot. Here's the thing though, Dan. One of the reasons why I wanted to zero down this episode on mid-career professionals is because what I have found in financial coaching is that a person reaches, say, 40, 45, 50, and they are absolutely frozen and do not act because they have this pile of savings. So they have savings, and they're diligent in savings, their salary or whatever, but they don't invest because, here's the thing, either they need a lot of control and they don't feel in control of the markets. They need someone to slowly hold their hand and explain everything to them, and nobody is doing that in the financial institutions. Or they can't afford coaching who would sit and explain everything to them. Or number 4, they have invested and suffered some loss in the past and say, you know what, I don't care, I want nothing to do with it. So in those kind of scenarios in which it all results to being frozen and not acting, procrastination. So let's just call it procrastination for whatever reason. Talk to me about that in your career experience, because you've been doing this for over 20 years.
Yeah, what you just described, Denise, is typical.
Okay.
So you will have a lot of professionals that are earning good money, and what they're doing is that they're just accumulating these cash in their savings account. So it's not being invested. So they have savings, they have cash. But of course, you know, the beast of inflation is going to erode
and you see
that
it in the
cash,
supermarkets.
and they're just sitting there. But what I often say to these professionals is that you're gonna have to take on the responsibility. You're gonna have to take on the responsibility to know, and if you are in a position that you don't have the capacity to have the control to make every decision, you're gonna have to pay for the service that is able to give you that service. You're doing a house transaction, you want the best lawyer. Whatever transaction you're doing, you want the best professional to handle that transaction. It's the same with your finances. It's very serious. You have to take your finances serious as how you take your health.
Yes.
You do not just go to any doctor to address whatever concerns you have. You don't go to a dermatologist when you're having a lungs issue. So if you're looking at your creating wealth, you're building a legacy, you want to ensure that the future generation is taken care of, you're planning for your children education, it's very important for you to get that coaching, get that financial advice that you need. And what it could mean is that you're actually paying a professional to help you because you don't have the capacity.
But that need for control.
What I will tend to say to some of my clients is, hey, we can do this together. What you want the client to do is to get very comfortable. Let them see that they want to develop a level of confidence in you. They want to get to that level that, hey, I think my professional, my wealth advisor, know what he or she is doing. And then slowly you will see they unwind that level of control.
But what about fear?
But the fear is there, so it's very important that you're having an open conversation and you're explaining to these clients, and you're saying to these clients, you're not making a decision now. You're going to think about everything that I've said to you, the pros and the cons, and you're going to go away, you're going to think about it. And then what is very important is to establish the risk profile of that client, because based on the risk profile, the recommendations that you give, 9 out of 10 times you will not have the pushback because the recommendations are tailored to their risk profile. So you wouldn't necessarily have that pushback, but it's very important. And when I say establishing that risk profile, it's not asking the client, what is your risk profile?
And most people don't know.
They don't know. And they will say to me, oh, I am aggressive, I want high heels. And I say, if I invest your money today, for argument's sake, in the stock market, and you would have invested $1 million. And when you look at your portfolio next week, you're seeing 750,000 in value. How would you react? And based on their response, I can tell that they're not aggressive. They're really not aggressive because they know that typically the higher the return, it's that level of risk that you need to take on. So really and truly, this client should really be in a BOJCD. You understand? Just earning a little above where they would get from investing in a savings account. So there's a number of ways as professionals in this industry, the questions that we can ask, the scenarios that we can paint to really determine what is the client's risk profile.
Okay, so let's go back to this whole global idea. So you're in the Cayman Islands, you're in the United States, you're in Canada, you're in Jamaica, you're in South Africa. How are you communicating and you want to open an account? Because in some instances you have to be a citizen to open an account, and some instances you don't. So for example, you don't have to be a Canadian citizen to open a Canadian account in Jamaica. They have a relationship. So how do you find out if your financial institution has a relationship with another financial institution overseas so that you can invest globally?
You simply ask.
Ask.
You simply ask your financial institutions that you are interacting with. I have an interest in the Canadian market. I have an interest in the Cayman market. Whichever market, do you have relationships? Typically, investment houses do. Typically. So it's really not difficult to get connected with those markets.
And why is keeping a global mindset, a diversified portfolio in multiple currencies, why is that important?
Simply diversification. Diversification to its core. So if you're here and you're here in Jamaica, can you say you have truly diversified when you have purchased stocks on the Jamaica Stock Exchange? These are companies that are in Jamaica. You are buying the government of Jamaica global bonds. That's exposure to Jamaica. You're buying a corporate note that is for a company that exists in Jamaica. So whilst you may say to me, I have Jamaican dollar investments, I have US dollar investment, I have global bond investment, and I have corporate bond investment. There's some level of diversification there. But on a much wider scale, you stepping out of the country or adding mix out of your country is giving you a broader diversification. From a global perspective, you're looking or you're able to invest in industries that are not here in Jamaica.
Also, like for Canada, you could do mining.
You could do mining. You could do all those different industries.
In Trinidad's oil.
Yeah, you could be in the semiconductor industry.
In the US.
In the US.
Yeah.
Whatever it is,
Right.
you have that true diversification.
Right.
And you can have it from a currency perspective as well.
Yes.
So your portfolio is consisting of US dollars, Jamaican dollars, Canadian dollars, sterling, diversification.
Right. Now, in terms of any regulatory impacts in dealing with multiple countries, is that your job as the financial advisor to navigate that, or should I have to keep up with that?
So definitely it's the role of the financial advisor to help the client to navigate. So each country would have their regulations, and we need to ensure that we're adhering to these regulations. So definitely it's the role of the financial advisor. If you're going in this particular country and it relates to real estate, you must know how is it you're navigating that space so that it is of an advantage to you and not a disadvantage.
Okay, now we all know about YouTube University and we know about a lot of the offers on the internet. Someone will say, I paid for this program and it's going to help me get to 5,000 US a month in 6 weeks. And so, but when I take my savings and give to you, you're telling me 1 year, 2 year, 3 year, 5 year horizon, having this long-term mindset, but I need money now. How do you have that conversation with mid-career professionals, especially when they're tired of their job and they want to make a quick move?
Well, what you gotta have to, the conversation has to be around what is exactly are you investing in?
I want quick money, Denny.
So quick money is what I can't promise you.
Okay.
Because I would be sharing with you asset classes that you're taking calculated risks based on the assessment that we have done, the valuation that we have done.
Right.
I promise no one that I can give them quick money. I have absolutely no crystal ball to promise that. If it is that you see that on whether it be social media, YouTube, I would not want to be able to be competing with that.
You don't consider yourself competing with that?
No, I'm not competing with that because I don't know exactly what is it that they're promising and if they can actually deliver it. But what I am promising, you can evaluate my strategy. You can evaluate my assessment. I can actually show you based on my valuation of this company and based on the valuation and the upside, this is what you could get in terms of a 15, 20%, etc. So I have sound arguments to support my investment.
So you give evidence-based.
Exactly, evidence-based.
In support.
Right. I'm not just cherry picking.
You're not okay. So remember, we're talking about multiple currencies, and we're talking about different options. The stock market in different countries. Jamaica, the United States, Canada, London, South Africa, the world is open. We're looking at mutual funds, same thing. There's mutual funds in Canada, mutual funds in Cayman, mutual funds in the United States, real estate investment trust, again, globally. Foreign currency, you can literally open a savings account and save in US, Canadian, Euro, Japanese yen. You can take these decisions. And then, of course, digital money, which is the Bitcoins and the different cryptocurrencies. Now, in putting that kind of global multi-currency portfolio together, Denise, how frequently should I be meeting with you or talking to you over Zoom or on the phone? How do we keep the relationship going to make sure I'm getting my objectives, whatever that may be? I may be saving for a house or my child's education or whatever.
So with that strategy or that approach of a global portfolio, the connection needs to be on a frequent basis because you investing from a global perspective, what it means is that yes, it gives you an upside, but it also has some elements of you experiencing risk. So you're here in Jamaica, and if you were just investing in your local market and something is happening in Tokyo, for argument's sake, that impact may not be immediate or you may not be experience that impact. But if you're on the Tokyo exchange, you could see that impact immediately. So what it means is that wealth advisor has to be on their toes as it relates to keeping abreast of the investments that you have done and keeping you informed. So in terms of meeting, it has to be, I would say, extremely frequent. But outside of meeting, we have to ensure that the communications, you're being fed the communications. One of the things that I will say to my clients is that if you're investing in a particular region, it's very important for you to know about this region. It's very important for you to listen to the economic report that comes out of this region, to be watching the business news, so to be in tune with same. So that is also the responsibility of the client, or you encourage the client to do, but that frequent communication is paramount in order to be on top of that portfolio.
All right. I need some cash, Denise. I need liquidity. Yes. I may be changing a job. My child may be going off to university. Need some cash. How do you balance that need with the long-term growth that that mindset that you come with when I work with you?
So in having a discussion with you as the client, whatever funds that you have to invest, it's never, the approach is not putting all of that funds totally invested in assets that are not able to access. So if you're really structuring a very diverse portfolio, a resilient portfolio, that portfolio is going to consist of investments that are considered to be long-term in a particular asset class that is able to give you that upswing in terms of appreciation, for example, real estate. But I must be able to have a robust portfolio that in the event that my client needs to access funds within 30 days or less than 30 days, what is the type of investment that I'm going to have considered to be liquid funds that I can still earn the best? So the portfolio, whilst you're getting that global exposure, it needs to also be in what considered to be different buckets so that you're able to achieve, so that long-term objective of that child going to university in 10 years, you have that there.
That's a bucket.
That is a bucket. You're looking to buy a house in 2-3 years.
That's a bucket.
That is a bucket. You want, for whatever you're saving towards, if it's your retirement, you want to be able to take a vacation next year. You want to be able to access funds in the event you see an opportunity that you want to seize. You need to have that in a shorter bucket as well.
All right, last point. What do you consider the role of a financial coach working with a financial advisor to help someone have a greater wealth mindset, a greater wealth understanding?
So the roles are close, but I think the distinction here is, so the financial advisor is going to establish your risk profile,
and they're licensed to act.
And they're licensed to act, and they're licensed to share these different investments that are evidence-based, that the assessment is being done, etc. The coach there, I would say, would come from the perspective of the mindset for the client.
Yes.
You want to establish where you're at.
Yes.
Is there any beliefs that you have had or cultivated
self-sabotage
over the years that are preventing you from moving forward? You want to address all of those.
That's right.
And then you want to establish what is the mindset that you want to have.
Yes.
And how are you going to get to that mindset?
Yes.
So the coach is working with the financial advisor and the client to achieve the ultimate objective of getting the portfolio, achieving the objective from a financial, and also for the client to be able to get to, some would call it an abundance mindset, but not just abundance from the perspective of you growing your wealth, but just your thinking.
Absolutely.
So I think they work well together.
Absolutely. Yeah. And I can tell you, the clients who have both, because remember, your financial advisor has the license to buy the stocks, the crypto, the real estate investment trust, the mutual funds. They have the license to act. The financial coach helps you to untangle what's going on inside your head or your heart so that you can overcome whatever is holding you back. And one of the things I can say to you, Denise, in my own career is that when you look at evidence-based, with coaching, people tend to self-sabotage themselves in about 10 different ways. And that's evidence-based. So we're not going to get into that in this episode. We'll talk in another episode. But I just wanted to say that when you take this big leap to have a portfolio that's not just in the country that you live in, but in the countries that you may be aware of or you may have family in, when you take that big leap, you have to have the right mindset and the right person to work with. Sure. Because the mutual funds, the stock markets, the real estate investment trust, the whole purpose of this is to grow your wealth, eventually grow your cash flow over time, and help you to have that really strong leg of the asset part of your financial table. My name is Dennise Williams. Thank you for joining us on Financially Focused. I'm going to encourage you to visit our website, www.financiallyfocusedmedia.com. Take our free 30-day financial independence course, and I will see you in the next conversation.